thank you for joining us today for another episode of Issuer Insights, brought to you by ETF Market Canada, where we invite industry experts to share their insights about the world, investing, and ideas for your portfolio. I'm extremely pleased to be joined by Adrienne Young, Portfolio Manager and Director of Credit Research, and Darcy Briggs, SVP and Portfolio Manager with Franklin Templeton Investments. It's great to have you both join us today.
Great. It's a pleasure to be here.
Good stuff. Okay, so let's dive right in. Darcy, how do you see the interplay between inflation, economic growth, and the Canadian dollar impacting fixed income investments?
It boils down to inflation and growth are actually the primary drivers of interest rates. And as a consequence, the primary drivers of interest rate policy or monetary policy. So it does follow the contours of the business cycle. So there are times when growth is increasing and inflation is falling. You'll have periods where growth is actually going higher, and so is inflation. Then you might get actual circumstances where growth is falling, inflation's increasing, and then you'll have both of them kind of fall together. So if you're in an environment where growth is or inflation is actually going up, usually you'll have rates going up at the same time because central banks will be hiking in order to try to bring inflation down. We saw that in 2022. If you have an environment where inflation is actually falling, you'll have interest rates generally coming down or being fairly consistent in terms of yield levels as central banks are actually reducing rates if it's a consequence of falling growth. So all that interaction of those two items do actually determine where interest rates are going. And currency is somewhat of a fallout of that because currency will reflect a number of different things, and that includes growth and inflation, but it'll also reflect interest rate differentials. And that would be, for example, what we have in our current environment where the Federal Reserve Board overnight rate is substantially higher than the Bank of Canada's. So at that particular, in that particular vein, you will see a stronger U.S. currency because it offers just a better relative yield than in Canada. So all of that goes into the mix, and fixed income markets are continually evaluating data as it pertains to growth and inflation. And as I said, as a fallout, what monetary policy is likely to evolve in being.
Yeah. So Darcy, then looking ahead, what would your outlook for interest rates be like for 2025, and what conditions would you think would be necessary for yield normalization?
Our view is that interest rates for the last couple of years needed to come down. Tariffs right now actually interject a new level of uncertainty into the economic mix. And as a consequence, we do continue to think that will also pressure rates to go lower as well. So overall, we think the Bank of Canada will likely need to cut rates 2 to 3 more times, and that would bring the overnight rate to 2. Longer term rates may come down modestly, but it's mainly going to be concentrated in the front end of the yield curve. So as the Bank of Canada started cutting rates in June of 2024, we had an inverted yield curve for almost 2 years, and the central banks do control the front end of the yield curve. And as a consequence, from the amount of rate action that the Bank of Canada has actually completed so far, the yield curve in Canada is pretty much normalized. So from 2 years all the way to 30 years, you have a nice upward sloping yield curve. It's the differential between the Bank of Canada overnight and the 2-year, which is still slightly inverted, but one more rate cut would flatten that, and 2 would actually normalize the yield curve from the overnight rate all the way out to the 30-year bond. So yield curve normalization has already occurred, but we are expecting a little more interest rate relief as 2025 moves along.
That's helpful. Adrienne, perhaps you could shed some light on the current state of credit spreads and their effect in the corporate space.
We think credit spreads are a little bit tight right now. They have widened out since the beginning of the year, but not by an awful lot. I think only about 12 basis points as of May the 8th. They're still only average relative to the, call it, post-Great Financial Crisis wides. Spread as a percent of yield is something that we like to look at. And it's only 28%. That is very close to, well, that is a level that we really haven't seen since about 2010. A little bit during the COVID period, but it's rare. It's very tight. In the US, the high yield investment grade basis, the differential between the two spreads is only about 258 basis points. Again, that is very tight by historical standards. Meanwhile, credit fundamentals from our perspective are looking like they're going to get worse. Tariffs, Canadian mortgage holders are out over their skis with regard to debt and are going to have to refinance beginning this summer the very inexpensive mortgages that they put on in 2021. So that implies some stress on the Canadian economy and probably increased default risk. And we don't think we're paid for that right now. So we're being a little bit cautious about strapping on extra credit.
Yeah, that would make sense. So Adrienne, maybe you could tell me a little bit about how you're adjusting FLCP, the Franklin Canadian Core Plus Bond Funds portfolio during this current environment, and maybe specifically comment on how you're managing duration positioning in this current environment.
FLCP is our flagship fund. It's what we call our Go Anywhere fund. So we have a lot of levers that we can pull, and we're pulling on a lot of them right now. We're still overweight credit. The fund is usually overweight credit. It's just a question of how much. So we are less overweight credit than we usually are. We're okay with being overweight credit because the spread that you get, the extra spread for corporate credit relative to government paper, we think that provides a cushion against movement in the underlying rate curve. So we're okay with that. But with that said, we tend to be, we're preferring very high quality credit right now. We're preferring highly liquid names and highly liquid issues. We're preferring paper that is less exposed to the Canadian consumer. So, for example, U.S. banks. We prefer U.S. banks to Canadian banks. The big U.S. banks, what are called the money center banks. We prefer U.S. industrials to Canadian consumer, for example. We like the pipelines. We're holding, you asked about duration. We're holding duration pretty close to the benchmark. Darcy will tell you that making big bets on duration is a tough way to make a living. With geopolitical risk being what it is, duration can really hurt you if you get it wrong. So we're just not willing yet to take big bets.
So, Adrienne, to wrap up, what should Canadian investors and viewers of this video be mindful of when investing today in fixed income?
The period of uncertainty that we saw and the period of volatility that we saw in April is probably not the only one. There is more volatility quite likely coming. And volatility is risk. The flip side of that is that volatility for the diligent, for the thoughtful, for those who have liquidity, and we've been working at that, it's also opportunity. So for investors who are looking at fixed income and saying, oh, finally, there is income again. If you're willing to buy an active fund, and I would argue very hard for buying an active fund in this environment, you get a combination of income and the diversification that'll give you a smoother ride. And there is the potential for some really outsized performance if we get volatility and we manage correctly during that period.
Excellent. Well, Adrienne, Darcy, thank you so much for being with us for today's episode. Really appreciate the insights that you've provided and given our viewers something to think about when it comes to fixed income investing. So I want to thank our viewers, speaking of them, for joining us for another episode of Issuer Insights, of course, brought to you by ETF Market Canada and sponsored by Franklin Templeton. Thank you. And if you're interested in learning more about Franklin Templeton ETFs, please be sure to visit franklintempleton.ca. Thanks for joining.